Every time you buy something, its price was set by two forces pushing against each other: demand and supply. In this video, we build the demand and supply diagram one step at a time. Find the equilibrium price where the market clears, then shift the curves to see how prices actually change. Get this diagram right and you can answer a big part of the AQA Microeconomics paper. Start with what a market really is. Anywhere buyers and sellers come together to trade. Buyers decide how much they want at each price, and sellers decide how much they will offer at each price. Price is the signal that links the two. Nobody sets it from above. It comes out of the interaction between what buyers want and what sellers are willing to provide. So we have two sides. Demand is the quantity buyers are willing and able to buy at each price. The law of demand says that as price rises, quantity demanded falls because the good becomes less affordable and people switch to alternatives. Supply is the quantity sellers are willing to offer at each price. The law of supply works the other way. As price rises, quantity supplied rises, because higher prices make selling more profitable. Notice both definitions say at each price, and that is exactly what a curve shows. Let's build the diagram. Price goes on the vertical axis and quantity on the horizontal axis. The demand curve slopes downwards from left to right. Read it like this. At a high price, quantity demanded is low, and as the price falls, quantity demanded rises. That downward slope is the law of demand drawn out. We label the curve D for demand. Now add supply. The supply curve slopes upwards from left to right. At a low price, sellers offer only a small quantity, and as the price rises, they are willing to supply more. That upward slope is the law of supply. We label this curve S. Now we have both sides of the market on one diagram, and the interesting part is where they meet. The two curves cross at one point, and we call it the equilibrium. Read across to the price axis to get the equilibrium price, P1, and down to the quantity axis to get the equilibrium quantity, Q1. At this price, the quantity buyers want to buy exactly equals the quantity sellers want to sell. There is no shortage and no surplus, so the market clears. Left alone, this is the price the market moves towards. What happens if the price is not at the equilibrium? Take a price above the equilibrium, up here. At that high price, sellers want to supply a lot, but buyers only want a little, so quantity supplied is greater than quantity demanded. That gap is a surplus, or excess supply. Now take a price below the equilibrium, down here. Buyers want a lot, but sellers offer little, so quantity demanded is greater than quantity supplied. That gap is a shortage, or excess demand. Now for the key idea. The market fixes these itself, through the price. When there is a surplus, sellers are left with unsold stock, so they cut the price, and the falling price reduces supply and raises demand until the gap closes. When there is a shortage, buyers compete for the scarce good and bid the price up, which draws out more supply and chokes off some demand. Either way, the price moves back to P1, where quantity demanded equals quantity supplied. That is the price mechanism doing its job. So far, the curves have stayed still, but the whole demand curve can shift if something other than the good's own price changes, like a rise in incomes, a change in tastes, or a higher price of a substitute. Say incomes rise and people want more at every price. The demand curve shifts to the right, from D1 to D2. Follow it to the new crossing point, and both the equilibrium price and the equilibrium quantity are higher. Higher demand pulls the price up. Supply can shift too. If costs fall, or a new technology arrives, or the government gives a subsidy, sellers can offer more at every price. So the supply curve shifts to the right from S1 to S2. Follow it to the new equilibrium. The price is now lower and the quantity is higher. More supply pushes the price down, A shift the other way, from higher costs or a tax, would do the opposite. This is the single most common mistake in the exam, so get it clear. If the good's own price changes, you move along the curve. That is a change in quantity demanded or quantity supplied. If anything else changes, an income, a cost, a tax, a taste, the whole curve shifts. That is a change in demand or supply. Movement along for its own price, shift of the curve for everything else. In the exam, the diagram earns marks quickly if you use it precisely. Where the curves cross is the equilibrium, so the market clears. A price above the equilibrium gives a surplus and the price falls. A price below gives a shortage and the price rises. And whenever a non-price factor changes, show the curve shifting to a new equilibrium. Always draw it, label both axes and both curves, and mark the before and after. 2 things to remember. First, every one of these diagrams assumes ceteris paribus, all other things held equal. So when you shift one curve, be clear that you are holding everything else constant. Second, do not just draw the shift, explain what caused it. Name the determinant, a rise in incomes, a fall in costs, a new tax, so the examiner sees you understand why the curve moved, not just that it did. 3 things to take away. 1. The demand curve slopes down, the supply curve slopes up, and where they cross is the equilibrium price and quantity. 2. Above the equilibrium there is a surplus and below it a shortage, and the price adjusts until the market clears. 3. A change in the good's own price is a movement along the curve, while any other factor shifts the whole curve to a new equilibrium. If that made demand and supply click, subscribe for the rest of the AQA spec, 1 point at a time. Next up, we will use this same diagram to see how governments change prices with indirect taxes and subsidies. Drop any questions in the comments.